we conclude on the theory part of this paper. We conclude on the theory part of this. I think that was the remaining part for the balance sheet under the 𝐂𝐨𝐿𝐻𝐸 Limited. I think there are those people who did it very well, and I marked, so you can as well check. Please take your time and check that. Take your time and check that. So this is August 2022, and we're looking at question number 1. How do we approach the theory? How do we approach the theory? With somebody who got, I think, the whole of that balance sheet question of statement of financial position. So you can just check what Mwalimu marked, and that will be it. That will be it. So the question number 1, we have, it's just a theory. This is what you expect. It can be, the theory question can be either question number 1 or question number 5. In most cases, that is the structure, either question number 1 or question number 5. So you can guess. Question 1 here, it happened to be a theory question, 1A. A number of developing countries are engaged in exploration of minerals to boost their economic empowerment. Your company, an international mineral exploration firm, has been contracted by one of the developing countries on a mineral exploration and evaluation engagement. Required, advise the board of management of the company on the following. Number 1, the relevant international financial reporting standard for accounting for exploration of mineral resources and the scope of the standard. 2, the key provision of IFRS in 1 above on impairment of assets used in exploration activities. Number 3, the disclosure requirements in financial statement under the IFRS. So class, that's the question. That's the question that we have at hand. And we are going to start with Roman number 1. We're going to start with Roman number 1. What are some of the relevant financial reporting standard? That is IFRS 6, exploration for and evaluation of minerals resources. What are some of the relevant points that we can have here for accounting for exploration of mineral resources? Can I get several from you? I think it will be prudent to first of all get something from that end. That exploration. What can you say? What can you say? And for this one, I can hint you. We base our argument. We base our argument on the entities involved. On the entities involved. Exploration. So I think for the sake of this lesson, we can have them. Roman number 1. An entity shall apply the IFRS to exploration. So it is always good to have them this way. An entity shall apply. An entity shall apply an entity shall apply the IFRS to exploration apply an evaluation expenditure that it incurs. Yet, at that point, kindly adjust. The screen is blurry. That is Everin. It's now okay. You can see from my end, it's very okay. Everin, I hope you're able to see. An entity shall apply the IFRS to exploration and evaluation expenditure that it incurs. So, if you incur any expenditure, it need to be applied. You need to apply the IFRS of exploration and evaluation. Right? That is point number one. That IFRS should be applied to that expenditure and that it incur. Number next, the IFRS does not address other aspects the IFRS does not address other aspects of accounting does not apply does not address other aspect of accounting by entities engaged. Entities that are engaged in exploration, it does not apply. Engaged, not end, yeah. In the exploration for the and evaluation of mineral resources. The IFRS does not address other aspects of accounting by entities engaged in exploration for and evaluation of mineral resources. So IFRS keep it separate. So any aspect of accounting in regard to the entities that are involved in exploration, it is kept separate. Number next, shall not apply IFRS to expenditure incurred. So the entity shall not apply the IFRS to expenditure incurred. Does not. The IFRS does. Okay. Does not. Yes. Does not address. Asante. Asante. Yes. Does not address. Yes. 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 It does not address other aspect of accounting by entities engaged in exploration for and evaluation of mineral resources. So it keep it separate. The final one, which is an entity shall not apply the IFRS to expenditure incurred. Expenditure incurred. It will elaborate more on this. Before the exploration for and evaluation, before the exploration for and evaluation of mineral resources. Of mineral resources, such as expenditure incurred, before the entity has obtained the legal rights or the entity has obtained the legal rights to explore a specific area. So, in this case, you find that if, for instance, the entity is searching for maybe the gold, is trying to explore to see where gold is. There are those expenses that are incurred before it gets the legal rights, maybe from the government, before it gets the legal rights. I had my legal somewhere. Yes, the legal right. Those expenses, those expenses are not applied by the IFRS. The expenses that will be incurred by the entity before it gets the legal rights, they will not be part of the part of the exploration or the evaluation. They are not termed as part of that. So, class, those are the three major areas relevant IFRS that we need to look at. The relevant IFRS that we need to look at. Then, part 2. We've been asked of the key provision of the IFRS in 1 above on impairment of asset used in exploration activities. So, there are those assets that will be used in exploration. You are trying to explore, evaluate those assets that are used. We want to see what does the provision under IFRS state. The provision under IFRS state. So you can have maybe the first one. The first one say IFRS 6 effectively modifies. So Roman number 2. IFRS 6 effectively modify IFRS 6 effectively modifies. You can have it as a progressive. Effectively modifies. Effectively modifies. The application of IAS 36. The application of IAS 36. IAS 36. Impairment of assets to exploration. Of asset. Impairment of asset to exploration and evaluation. And evaluation. Exploration and evaluation. And evaluation. Asset recognized by an entity. Asset recognized by an entity. Recognized by an entity under its accounting policy. Under its accounting policy. Under its accounting policy. Under its accounting policy. So maybe to be specific, we can say that entity recognizing exploration, specifically entities recognizing exploration and evaluation, entities recognizing exploration and evaluation assets. And evaluation assets. Are required to perform an impairment test. Are required to perform an impairment test. You know, impairment is the reduction of value of that asset. They are required to perform an impairment test. An impairment test on those assets. Test on those assets. When specific facts and circumstances. When specific fact, fact and circumstances. When specific fact and circumstances outlined in the standard indicate. Outlined in the standard indicates. Outlined in the standard indicates. An impairment test is required. Indicates an impairment test. Test is required. Yeah. So the impairment test need to be done. Impairment tests need to be done so that you're able to see and to know what is the loss of value of that asset. The next one, entities are permitted to determine. Entities are permitted. Entities are permitted to determine an accounting policy. To determine an accounting policy. entities are permitted to determine an accounting policy for allocating exploration, for allocating exploration, and for allocating exploration and evaluation assets exploration and evaluation assets for allocating exploration and evaluation asset to cash generating units units or a group of cash generating units. So CGU or a group of cash generating units, or a group of cash generating units, or a group of cash generating units, or a group of cash generating unit. So under that, you find that the accounting policy may result in a different allocation than much that otherwise arise on applying the requirement of IAS 36. So it may come with different policies in that angle. And the other one is disclosure requirement. Roman number 3, disclosure. Remember, examiner will bring for you some disclosure requirements of what do you need to disclose? What do you need to disclose as far as this is concerned? An entity shall disclose the following. 1, its accounting policy. So it should disclose its accounting policies. Which are the accounting policies that have you used for exploration and evaluation? And evaluation expenditure. Evaluation expenditure, including the recognition of exploration, including the recognition of expenditure of exploration and evaluation asset. Exploration and evaluation asset. And evaluation asset. So that means these need to be disclosed. The accounting policy that the entity is using, it really need to be disclosed. It really need to be put in open for people to get it clear. The accounts or the amount of asset. Number 2, the amount of asset another thing that need to be disclosed. Amount of asset, liabilities, income and expenses, income and expenses, and operating and investing cash flow. Investing cash flow in that exploration. Remember, these are unique case. So, arising from the exploration, arising from the exploration for and evaluation of mineral resources. Evaluation of mineral resources. Evaluation of mineral resources. So disclosing this is also important. Yes, how much are you earning? How much expenses are you using? What are some of the operating and investing cash flows, right? Arising from what? From all the activity. From all the activity that are being undertaken. And any the other disclosure, the disclosure, all assets that are used in exploration and evaluation should be treated as a separate class. Should be treated as a separate class. Class of asset. Yeah, those assets that are used in exploration and evaluation should be treated as a separate class. So that disclosure needs to be done. And you can use either IAS 36 or IAS 38. IAS 36 or IAS 38. So class, those are some of the items that that question required. Of course, it was a pure theory. It was just a pure theory, a pure theory. Kindly finish up so that we finish part B. Part B, I want us to look at the paper. After this, we are looking at the paper that I told you to attempt yesterday. I hope you've done it. I think it was August 2024. That is the paper that we're looking at after part B, after looking at part B. So are you done up to this point? Remember, you just getting it at a higher level. Just understand something from this exploration and evaluation. So ukipatana swali relating to the same, you can at least apply. Are we all done up to this point? Are we all done? Confirm once you're done. So that we can move to the next part. Tumemaliza. Ukimaliza useme Julia amemaliza. Aha, two more individuals to confirm. Want us to look at Jane. That's better. So number next, theory question. This is how theory comes. International Public Sector Accounting Standard, IPSAS 1. Presentation of a financial statement provides that financial statement shall present fairly the financial position, financial performance, and cash flow of an entity. In the context of the above statements, 1. Describe what fair presentation of financial statement entails. I know you have done audit. Fair presentation. It should not have errors, and it should be, in fact, dictated in a true way. Next, explain the disclosure requirement where an entity departs from a requirement of the 𝐸𝐴𝑟𝐻. You see, disclosure, this question on disclosure, please go through all the disclosures that we have under these. Most of them are in topic number 1, the disclosure requirement. Please go through all those. Disclosure question, I think that is the major area where the examiner tend to bring questions from. Disclosure requirement. What are some of the things that the entity need to disclose to the public? Entity need to disclose. So let's start with the first one. The first one, describe what fair representation of financial statement entails. So class, when we talk about fair representation of financial statement, you can say that one, fair representation, financial statement, this is not okay. You can say that financial statement, we've got another pair here. Financial statement shall present fairly the financial position the financial position, financial performance, and cash flow. Financial performance and cash flow of an entity. Fair representation require the faithful representation. Add value. Fair representation require a faithful representation of the effect of transaction. So faithful representation, faithful, truthful, true and fair view, faithful representation, faithful representation, of the effect of transaction. So it should not be full of biasness. It should not be full of biasness. Other event and condition in accordance with the definitions and the recognition criteria for asset, liability, revenue, and expenses set out by 𝐸𝐴𝑟𝐻. So there should be a faithful representation of all those items in regard to 𝐸𝐴𝑟𝐻 standard. 𝐸𝐴𝑟𝐻 standard. So statement of financial position, statement of comprehensive income, and cash flow. The items that are displayed there, they should reflect a true and fair what? A fair view. Next, the application of 𝐸𝐴𝑟𝐻 with additional disclosure when necessary. Disclosure when necessary. Additional disclosure when necessary is presumed to result in financial statement. Is presumed to result is presumed to result in financial statements that achieve is presumed to result in financial statements that achieve a fair presentation. 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 Next, an entity whose financial statement comply with 𝐸psas. An entity whose financial statement comply with an entity whose financial statements comply with 𝐸psas. Comply with 𝐸psas shall make an explicit and unreserved statement of such compliance. Statement of such compliance in the notes. That one should be unreserved. So, because if you look at these, for a company or an entity to achieve the fair representation, it needs to comply with the 𝐸psas. That's standard. So it's just simple. Just by complying with the 𝐸psas, it is presumed that the entity has done what? Has represented itself fairly. Represented itself fairly. So following the standard is the key. Following the standard is the key. That is it. I think we can look at the disclosure requirement. Disclosure requirement. Disclosure requirement. This is Roman number 2. What are the requirements for this disclosure? Disclosure requirement. One, the management has concluded that the financial statement present fairly the entity financial position, financial performance, and also cash flow. It's like we just now are trying to report. Report that the entity has represented the fair view of those financial statements. The fair view of those financial statements. So the management has concluded that the financial statement present fairly the entity's financial position, financial performance, and cash flow. That is disclosure number 1. Lazima ikuwe reported like that. That whatever that has been presented is indicating fair view of this. Fair view. So this is what we say. That the financial statement the financial statement present fairly the entity's financial position fairly the entity's financial position, financial performance, and cash flow. So indicate that the entity has really presented a fair what? A fair view of the financial statement, a fair view of the financial statement. Remember, when we say financial statement, we are mentioning or we include the component of financial statement. Number two, that that it has complied with the applicable IPSAS. It has that. Remember, the management is reporting that it has complied with applicable IPSAS. With applicable IPSAS, except that it has departed from a particular requirement. Except that it has departed from a particular. It has departed from a particular requirement to achieve a fair presentation. From a particular requirement to achieve a fair representation. So this disclosure, class, is just trying to indicate that the company is complying with what is required to an extent that they omit or they depart from a particular requirement which could have manipulated their representation, their fair representation, or distorted the fair representation. So you just disclose those information. You just you tell the truth, right? You tell the truth. You tell the truth. What has transpired? What has transpired? Right? Yes, we complied with IPSAS. We even departed or eliminated some of the things that could have brought what? A biasness. That could have brought a biasness which would have led to unfair representation. The next one, the title of the standard from which the entity has departed. So you have to give the title of the standard. You have to substantiate standard from which the entity has departed. From which the entity has departed. The title of the standard from which the entity has departed, the nature of the departure, including the treatment that the standard would require, the reason why that treatment would be so misleading in the circumstances that it would conflict with the objective of the financial statement set out in this standard and the treatment adopted. You see, all these things are to make sure that, yes, you told us that you departed from a certain standard. Yes, that could mislead your fair representation. Okay, then go ahead and give us the standard. Tell us, how have you departed from it? How could it mislead your fair representation? So through that, you'll be able to, or the person in charge, you'll be able to say Actually, these people did it in the required way. The other one, I'll not elaborate much on that. You understand? For each period presented, the financial impact of the departure, on each item in the financial statement, statements, that would have been reported, that would have been reported, in complying with the requirement. That would give you a point there. The other one, when an entity has departed from a requirement of a standard in a prior period, and that departure affect the amount recognized in the financial statement for the current period, it shall make the disclosure set out in paragraph 32. That one, you wachana tunayo. So they're just trying to show that yes, you have departed from a certain standard, so that you can give us the true and fair view of the statement. That's okay. Then you must indicate from which paragraph is that. All those items. So class, you just, once you find some theory, just try to think about it, trying to revolve around any concept that would give you what? That would give you some marks. Remember, for such theories and financial reporting, since we are referring to several standards, you have to be specific to the same standard, And that is it in regard to that paper. For those people who did the whole of that paper, you can gauge yourself. You can try to gauge yourself. I know in most cases the theory is a challenge, but never be challenged, right? If it become a challenge, it's not clear. And it's okay now. Where can't you see? I can see it's now okay. It's only that ilikuwa imekuwa blurred kidogo. I think it's now okay, And all right. So class, that is it. In regard to that theory, that is it. So for those people who did it, you're able now to gauge yourself where you are. Let's look at August 2024. And still I want to start still in this first paper, question number 1, do you require theory? So expect a theory, partners, Peter anasema August 2024 we start with partners. No problem. But I want to mention these theories so that at least you have something. So for this, I'll just mention theories. I'll just mention theory very fast, and then in in fact, this paper, we shall look at it, the whole of it, so no worries. Hii tutaangalia tu pole tu. So, ustahili kushtuka sana. Partners, yeah, partner, we must look at it. Maybe we can give it priority after the theory. So, August 2024, question number 1. Question number one. Before we get to the partners question. Yeah, this is a nice one. If, by the way, wacha nikwambie the secret. If you understand the two papers very well, you'll find it very easy to get to the next level. If you look at the two papers very well. I think they cover the whole syllabus. So, number 1, distinguish between taxable. I think that distinguishing between taxable temporary difference and deductible, that one you did. So let's go to B. Explain 3 limitations of common size financial statement. Class, limitations. What are some of the limitations of common size financial statement? Imagine given 6 marks to just explain limitations. Class, can you give me those limitations? What are some of the limitations? The first thing you need to identify, what is the common size? Yeah, it's a method, it's a tool used to analyze financial statement. Now, what are some of its limitations, class? Somebody? Some of its limitations, let's talk. Limitations. Somebody is giving me some limitation. Limitations. 6 marks. Assume umepatana na hiyo swali kwa mtihani, ungefanya namna gani? It fails to recognize qualitative element, that is Eric. So it go with the quantitative. Okay. Qualitative element. Any other? And my knee is misbehaving here. Any other? So I think we can mention them. The first one is the standard ratio. We say that it's a standard ratio. Common size statement does not help in does not help to make a decision, since there is no standard ratio or percentage regarding the change of a percentage in various components of asset, liability, and sales. Remember what we say? Question paper, and you need to have it because this is the paper that everyone was doing yesterday. It is something that you were to do yesterday. So, can you check? Somebody can as well share in the group. So, standard ratio, due to lack of that standard ratio, it give it as a limitation. Number next, change in price level. Common size statement does not recognize the change in price levels. Inflationary effect. So it may supply misleading information since based on historical cost. It is based on historical cost. So we just refer to what was there in the previous year. So we're basing our argument in a historical cost. We're basing our argument in a historical cost. Then we have consistency. If consistency in the accounting principle, concept, and convention are not maintained from one financial period to the other, then common size statement may not be useful. So it requires consistency. You see that the base figure will always be there. As far as the income statement is concerned, it will be there at the sales. As far as the balance sheet is concerned, it will be the total asset. That consistency is paramount. Then seasonal fluctuations. Common size statements first convey proper records during seasonal fluctuations in various components of sales, assets, liabilities, among others. Sale and closing stock significantly vary. Therefore, the statement fails to supply the real information to the users of financial statements. Yeah, because of the variation in those items that I've mentioned. So you find that the information displayed to the users of financial statement is not correct. Yes, in some cases, it may not be correct. Then we have window dressing, where there is a window dressing in an original statement, or the common size statement may also be affected and leads to giving the wrong impression about a business. I think class, that is it. That is it. Then hapo chini part C walikuwa nakuuliza kuhusu 𝐴𝐵𝑆𝑠 as well. 𝐴𝐵𝑆𝑠. So class, I think that is better. That's better. Please go and check that. Please go and check that. Then number 2, you've been given a group question, a nice one. A nice one. A nice one. A nice one. I know you guys managed to do this. That's true. You managed to do it? Sasa ukipatana na group question, hufai kuacha. You managed to do the group question, class? The group question number 2, just mention to me. Just give me a signal. You managed to do the group question? And I need to check my camera here. Camera is misbehaving. 1C and D, ala. Eric, anataka tuanze 1C and B. Okay, sawa, Eric. We hit to that then. We hit to that. But first of all, you guys, can you answer me? Did you manage to do part 2? You know, it's always good to revise something that at least you have done. At least you have attempted. Did you manage to attempt question number 2? You know, we might be here. Maybe we are starting it from scratch and some people never tried, which is not okay. Did you manage? We are there. The part of goodwill. You managed to do the part of goodwill, okay? Okay. What did you get as the goodwill for the first one? You know, you have to get the goodwill for the 2 companies. Of course, the subsidiary and the associate. Okay, for 80. Okay, sawa. It's okay. We shall be looking at it, by the way. And looking at all these, we shall be looking at them at a high level. Not that I'll just go to the letter by letter. No. I'm just giving the overview. I'm just giving you, reminding you what should be done. By the way, were you able to get to know the percentage, the percentage acquired, the percentage of shares acquired? You know, I chose all those questions so that at least you're able to see how examiner may bring. Wakati mwingine hata kwambia ati 75% of shares acquired, hapana. Wakati mwingine akupatia vitu tofauti. So if you're able, so between the 3 companies, can you tell me the group structure? Excel Limited ilikuwa nini? Yep Limited na Z Limited. How did you identify? Excel Limited was which type of a company? Before we get back to the 2 theory. Parent, hiyo ingine, Yep Limited. Yep Limited, and for that one, you give me the percentage. And today I have Eric. Where are the rest? Where are the rest? Does it mean that people did not do the paper? Is that the case? Allah? 80%. Thank you. Yes, that is good. That is good. The other company, percentage? If you have that knowledge, but I'm not happy just seeing one person. 30%, great. Good. If you really manage to do that, mambo ilikuwa sawa. So let's get back to question number 1C. Question number 1C. So International Public Sector Accounting Standard IPSAS 45, Property, Plant and Equipment, provides public sector entities with a choice between the historical cost model and the current value model. in the measurement of items of property, plant, and equipment. With reference to IPSAS 45, property, plant, and equipment, explain the accounting treatment of revaluation increases and revaluation decreases relating to property, plant, and equipment in the financial statement of an entity that adopt the current value model. So what I liked about this question, even we have the movement of these non-current asset. We have a movement question. So to address that, in regards to IPSAS 45, these are the public sector, IPSAS 25, you can say that in the carrying amount of a class of asset, if the carrying amount of a class of asset, another name for carrying amount in gani class, another name for carrying amount in gani, another name for carrying amount, we need the net book value, yes. So if the net book value of a class of asset is increased as a result of revaluation, if the net book value is increased as a result of revaluation, you see, so that is revalued upward or downward. If it is increased, it is revalued upward. Revaluation upward, that means the value of that item has been revalued upward. Does that state? The increase shall be credited directly to revaluation surplus. You see that item, the element of increase will be credited directly to revaluation surplus account. So that is one item. However, the increase shall be recognized in surplus or deficit to the extent that it reserves a revaluation decrease. So you are writing. That means today we're looking at a theory kabisa, but I don't want to write this. Just have it then. If the carrying amount of a class of asset, if the carrying or net book value is increased as a result of a revaluation, the increase shall be credited directly to revaluation surplus. That increase. If the net book value was maybe 2 million and then it was revalued to 2.2, so that 200,000 shall be credited to the revaluation surplus account. Number next, however, the increase shall be recognized in surplus. However, the increase shall be recognized in surplus or deficit. In surplus or deficit, the increase shall be recognized in surplus or deficit to the extent that it reverses. This is important. The increase shall be recognized as surplus or deficit to the extent that it reverses a revaluation decrease of the same class. It reverses a revaluation decrease of the same class of asset previously recognized in surplus or deficit. So in such a case, the reverse is experienced. Increase shall be recognized in surplus or deficit to the extent that it reverses a revaluation decrease of the same class of asset previously recognized in a surplus or deficit. So class, let's just refresh for 5 minutes. Just refresh for 5 minutes. Just refresh for 5 minutes. Yes, recognized in surplus or deficit. Recognized in surplus or deficit. And the next one, if the carrying amount of a class of asset, if the carrying amount of a class of asset is decreased as a result of revaluation, the decrease. If the carrying amount of a class of asset is decreased as a result of revaluation, the decrease shall be recognized in surplus or deficit. The decrease shall be recognized in surplus or deficit. Shall be recognized in surplus or deficit. However, hope you are up to the point. However, the decrease shall be debited directly to revaluation surplus. The decrease shall be debited directly to revaluation surplus to the extent of any credit, balance existing, in the revaluation surplus in respect to of that class of asset, that is it as part of part C. Then the other one class, you have to do this, citing examples, describe the accounting treatment of changes in accounting policies in line with the International Accounting Standard 8, accounting policies, changes in accounting estimate and errors. Ukitumia example, as an entity should only change its accounting policy if required by the IFRS standard or if it results in more reliable and relevant information. By the changing the accounting policy, it follows certain steps. There are some steps followed, right? You can just wake up in the morning and you tell your people that you're changing a certain policy. No, they should follow the requirement. It should follow the requirement. So tunasema kwamba an entity should only change its accounting policy. This is important. You might get it somewhere. Regarding the frameworks and such, coming up with a standard and the process is followed. So an entity should only change its accounting policy if required by an IFRS standard. Si kubadilisha tu, you change if it is a requirement by the standard. Policies. Or if it results in more reliable and relevant information. Yet, if the policy that you want to change, it will result in a more reliable and relevant information, you can go ahead and change. But you have to prove it, that it is more better than what was there. Right? So changing the policies is not just that easy. You have to follow some rules or some standards. Next one. New accounting standard. I repeat, Mwanamisi anataka turudie wapi? Pande gani Mwanamisi? Mwanamisi anataka turudie mahali fulani, sasa turudie wapi? Mwanamisi. From where? An entity should only change its accounting policies if required by an IFRS standard. You get? So, if it's not a requirement by the standard, or it's not something that will be more relevant and bringing more accurate answer, you should not. So you're saying that an entity should only change its accounting policies if required by IFRS. Right. Comma. Or if it results in a more reliable and relevant information. So if the standard or the policy that you want to change is bringing more reliable and something that is more understandable by the people or the users, that's better then continue and bring the change. Continue and apply the change. Mwanamisi, are we together? Are we together? Are we together? Pamoja. Good. Number two. New accounting standards normally include transitional arrangements on how to deal with any resulting changes in accounting policy. It's a process. For example, kuna standard. There's a standard I told you that it is already changed. It is already changed, but has not taken effect. It is already changed. Can you remember the standard that I told you? The standard that I told you, it is replacing IAS 1. I will repeat. So today we are looking at the theory. And then anyone who has not looked at this paper, kindly, you'll be getting a second chance to look at it. Remember, we don't want to come back here again, right? We want to keep on moving, right? So please, if you've not attempted the paper, please do it. So tutakuwa tumemalizana na question number 1. So the next time we meet, we shall be looking at the computation. Na paper ya accounting, financial reporting inakaa hivi, right? Inakaa hivi. So you can even gauge yourself with this paper. How far can I get? Am I able to finish the 5 questions within the given time, right? Tunasema IAS 1 will be changed with IFRS 18, but that will take effect in January 1, 2027. That will take effect that time. But already that thing, every process, kila kitu changiwa. Okay, number 2. New accounting standard normally include transitional arrangements. Transitional arrangements on how to deal with any resulting changes in accounting policies. On how to deal with any resulting changes in accounting policies. Get? Next, if there are no transactional arrangements, change in accounting policies should be applied retrospectively. Retrospectively. What does that mean? Retrospectively. We refer to, we try to trace toka nyuma, the previous, tunakuja tukiwa tuna amend ama tuna change, tuna bring the change. If there are no transactional transitional arrangement, change in accounting policy should be done, should be applied retrospectively. That means you come from previously made standard, you keep on changing until you get to the right version, or the required version. Next, the entity should adjust the opening balance of each affected component of entity, and the comparative figures are presented as if the new policy had always been applied. So hii inamaanisha kwamba the opening balances of each affected component of equity need to be adjusted. And now the new policy inaletwa ndani. So whatever that was previously done, we come and adjust some figures that are affected, and then we apply the new figure. Hapo ndio tunaita overlapping, overlapping. So there was something that was in progress, of course, and then we bring a new one, like that. So there's that ka overlap kidogo hapo, so that we can now proceed with a new policy. New policy, old policy tumeachana nayo. But now before tuachane nayo, this is what happened. This is what was missed by our government, the overlapping thing. They failed to do this. You see this period between here and there, the overlapping section area, that area. That is what they left when they were changing NHIF to SHA. And that's why Mashida, there's a lot of problem. Class, if you're bringing in a change, always remember to do this, right? If you're bringing new employee and you want the employee to replace somebody who is there, kindly allow this somebody who is in existence, who has been there, to at least orientate, give orientation to this person, right? Before they exit. So there's that time for orientation, that overlapping period. Very important for the company. Very important for, see, kutoa tu, my friend, it will shake. Your company will shake. Will shake. Utakuwa na shida mingi sababu kuna vitu zenye haziendi nini vizuri. I think okay, examiner wanted some examples. Changes in recognition such as an expense is now recognized rather than an asset. So some examples go pale. Changes in presentation such as depreciation is now included in cost of sales rather than administrative expenses. You know, when we are preparing the published, sana ma changes inafanyika pale, published financial statements, you see that we just condense expenses. There are those now expenses that are taken to the cost of sale and they were previously in the admin expenses. Changes in measurement such as stating assets at replacement cost rather than historical cost. All those changes do come and they replace what was there before. Sasa class, hapo ndio theory imefika, and I hope you're able to see how theory is tested. Any other theory unaweza pata kwa financial reporting after umemalizana na hiyo full question theory 20 marks. Hiyo ingine I don't think inaweza pita marks 6. Examiner anaweza tu uleta mahali tu kamoja tu ama ukose. So theory ni swali moja. And the structure is you can get it at the start of the question or at the end. Inaweza kuwa question number 1 ama question number 5. You just know that. So kuna theory swali moja max 20. So class, I think let that be it for today. Unless if you wish I touch on the goodwill thing under this group question. I touch on the goodwill thing on this question. But I wanted us to look at the computation in our next lesson. Will that be in order so that I give a chance for you who have not attempted to attempt, the remaining questions? Time yourself. Kindly, this one I'm just begging you, kindly time yourself and do the paper. Through this paper class, you see change. So it will help you to at least review. In order, mwalimu, we go attempt first. Yes. So kindly for those people who did not manage, please go and attempt the whole of this paper. And then wakati tutakuwa tukirevise, mark for yourself. Gauge yourself. That is it for today, unless we have a question Allow mwalimu to edit at that point. Allow mwalimu to edit at that point. Anyone with a question? Anyone with a question? Swali lolote? Okay, having no any other business, allow us to end our session on that point. Thank you so much for having time to attend our today's class. Peter, the makeup Saturday class, we shall just communicate. We shall just see whether we will be having it. But as per now, the only class that we are remaining with this week is on Thursday, and then next week still Tuesday and Thursday, like that. So any other arrangement we shall communicate in the group. Thank you so much. Have a blessed day. Goodbye.